Imagine this. For 80 years, the US dollar has been the undisputed king of global finance, the bedrock of every major economic decision, the safe haven for every central bank, the very oxygen of international trade. We've been told it's too big to fail, too stable to question, too essential to ever be challenged. It's the ultimate financial superpower, backed by the unwavering trust of its closest allies. But what if that trust is crumbling? What if the very allies we depend on are quietly, systematically dismantling the dollar's reign? In just the last year, we've witnessed Japan, America's largest foreign creditor, holding a staggering $1.2 trillion in US Treasuries, openly discuss liquidating hundreds of billions of those holdings. We saw their finance minister, Katsunobu Kato, describe those treasuries as a card on the table in trade negotiations, a direct threat. And Prime Minister Sanae Takaichi's tax policies sent Japanese bond yields to 40-year highs, triggering a sell-off that rippled through global markets in a matter of hours. All while the Bank of Japan raised interest rates to levels not seen since 1995. And yet, the yen somehow kept getting weaker. At the exact same time, the BRICS nations, Brazil, Russia, India, China, and South Africa, have been on an unprecedented gold buying spree, accumulating over 6,000 tons. They've established new payment systems to bypass SWIFT, and are now conducting 90% of trade between Russia, India, and China without using a single US dollar. China has aggressively sold off 1/3 of its treasury holdings in the past 5 years. Central banks around the world have added over 1,000 metric tons of gold for 3 consecutive years, and the dollar's share of global reserves has quietly plummeted from 88% in 2000 to just 59% today. Treasury Secretary Scott Bessent has publicly expressed concern about Japan's bond market impacting US Treasury prices. Danish pension funds are announcing they'll dump their US debt holdings by month's end. A massive wave of Treasury selling hit Asian markets so hard in April 2025 that it forced the administration to pause its reciprocal tariff plan. This isn't doomsday panic. It's a cold, hard look at the facts. Something fundamental is shifting, and it's happening faster than anyone predicted. If the global financial system is built on trust, then that trust is being stress tested with a sledgehammer. Yet the dollar hasn't collapsed. Treasury markets, despite all this pressure, are still functioning. Yields have spiked, sure, but we haven't seen the catastrophic unraveling that many predicted. The American economy grew by over 4% in 2025, even as all of this was happening. Markets, which are supposed to hate uncertainty, managed to hit new highs in several stretches throughout the year. This is the paradox. The evidence of de-dollarization is overwhelming, yet the dollar persists. But for how long? With Japan holding $1.2 trillion in US Treasuries as of November 2025, making it by far the largest foreign creditor to the United States, and with whispers growing louder about repatriation to support their own currency, it does raise one very uncomfortable question. Why hasn't Japan pulled the trigger yet? And what happens to your savings, your investments, and your future when they finally do? Stay with us, because the answer will redefine your understanding of global finance. Now, your first instinct, and frankly, the prevailing wisdom for decades, is probably screaming, this is just fear-mongering. Japan would never actually dump US Treasuries. It's financial mutually assured destruction. They'd hurt themselves just as much as us. And you'd be right for a long time. Where else would Japan park $1 trillion? Their own government bonds offer abysmal yields. Their economy has been stagnant, and they need safe, liquid assets denominated in a stable currency. This argument has been the dollar's impenetrable shield. It's why China, despite all the trade tensions, still holds $784 billion in treasuries as of February 2026. It's why the petrodollar system persisted long after its geopolitical reasons started fraying. It's why every previous wave of de-dollarization talk turned out to be premature. But here's the critical difference, the one that makes "this time is different" actually true. The Bank of Japan, in a move that sent shockwaves through global markets, raised its benchmark rate to 0.75% in December 2025, the highest level since September 1995. For a country that spent nearly a decade with negative interest rates, this isn't just a tweak, it's a seismic shift. Yet, even at 0.75%, Japan's real interest rate remains deeply negative at approximately minus 2.15% when you factor in their inflation, which has been running above the Bank of Japan's 2% target for 44 consecutive months. This means Japanese investors, from massive institutions to individual households, are actively losing purchasing power by holding yen-denominated assets. Every day, their savings are eroding. And the paradox deepens. Despite these rate hikes, the yen has actually weakened. USD JPY has been trading stubbornly in the 155-157 range, and strategists at JP Morgan, BNP Paribas, and other major institutions are now predicting the yen could weaken to 160 or beyond by the end of 2026. How is this possible? How can a central bank raise rates while its currency plummets? The answer lies in the persistent interest rate differential between the US and Japan. Carry trades remain irresistibly attractive. Investors are still borrowing cheap yen to invest in higher yielding assets elsewhere, primarily US Treasuries. Furthermore, Japanese households and institutions have accumulated a staggering $9.4 trillion in net purchases of overseas stocks via investment trusts in recent years, demonstrating a structural preference for foreign assets that won't reverse overnight. This is a slow-motion train wreck where the tracks are shifting beneath the wheels. But the real accelerant, the true spark that could ignite this powder keg, came when Prime Minister Sanae Takaichi unveiled her plans to pause Japan's consumption tax ahead of snap elections. Japanese government bond yields exploded. The 40-year JGB yield rocketed above 4% for the first time on record. The 30-year US Treasury yield, in turn, climbed to its highest level since September. Volatility rippled through global markets because when Japanese bonds sell off, it creates a powerful incentive for Japanese investors to repatriate capital from foreign markets, including US Treasuries, to buy now higher-yielding domestic bonds. As George Catrombone, head of fixed income at DWS Americas, eloquently put it, the true accelerant to the Treasury and dollar sell-off seems to be Japan and concern of repatriation from global markets to support higher inflation and JGB yields. This isn't a political statement. It's basic portfolio management. If Japanese investors started rotating even a fraction of their overseas holdings back into domestic bonds, it wouldn't be some dramatic political statement or trade war tactic. It would just be rational economic actors responding to changing yields. But the effect on treasury markets would be exactly the same, a tsunami of selling. However, that's still not the whole story. The mechanics of currency intervention and what it truly means when a finance minister describes treasury holdings as a card on the table deserve even deeper scrutiny, because the implications are far more dangerous than most people realize. If you're finding this analysis valuable, hit that like button and subscribe to Finance Deciphered. We're just scratching the surface of this global financial earthquake. Okay, so yes, Japan is facing a situation where higher domestic yields could naturally pull capital back home. That's economic repatriation 101. But what makes this particularly precarious is that Japan doesn't just hold $1.2 trillion in US Treasuries because they like the color of American money. They hold them because they've spent decades intervening in currency markets to keep the yen weak, making Japanese exports incredibly competitive. These interventions required them to sell yen and buy dollars, which then got parked in treasuries because, frankly, where else would you put $1 trillion with guaranteed safety and liquidity? But now, the situation has dramatically reversed. The yen's weakness, once a strategic advantage for Japan's export-driven economy, has become a critical vulnerability. Import costs are surging, domestic inflation is stubbornly high, and politicians are facing immense pressure to do something about the rising cost of living for their citizens. Itsunori Onodera, chair of the Liberal Democratic Party's Policy Research Council, publicly stated that the weak yen has been among factors pushing up prices, and explicitly called for strengthening the currency. To achieve this, Japan would need to buy yen and sell dollars. And what's the biggest, most liquid pile of dollars they have sitting around? That would be the $1.2 trillion in US Treasuries. The choice is becoming stark: protect their own citizens or protect the US dollar. Finance Minister Katsunobu Kato tried to walk back the card on the table comment after it sent markets into a brief panic, claiming it was taken out of context. But the damage was done. Just the suggestion that Japan might use its treasury holdings as leverage in trade negotiations was a monumental shift, precisely because Japanese officials historically never even mentioned this possibility. As the Financial Times described it, it was a rare baring of teeth. Even if Japan doesn't weaponize these holdings intentionally, the practical realities of managing a colossal $1.5 trillion government pension investment fund, GPIF, mean they might not have a choice. The GPIF, which holds the Social Security reserves of nearly every Japanese worker, has approximately $400 billion in US Treasuries. If JGB yields continue rising and offer genuinely competitive returns adjusted for currency risk, the fund's stewards would have a fiduciary duty to rebalance toward domestic assets. That's not economic warfare. That's just their job. And an additional $800 billion held by other Japanese pensions and financial institutions could follow the same logic. We're not talking about a conspiracy or coordinated attack. We're talking about rational economic actors responding to incentives, which, in a system this interconnected, might be even more dangerous than a deliberate strategy. It's like a slow-motion domino effect, where each piece falls not by malice, but by simple gravity. And it gets worse, because Japan isn't operating in a vacuum. The same dynamics pressuring Japanese institutions are playing out across the world, just with different timelines and different triggers. China, the second largest foreign holder of US, Treasuries with $784 billion has been systematically reducing its holdings for years. Between 2020 and 2026, China sold off roughly 1/3 of its treasury portfolio. Some of that was to defend the yuan during periods of capital outflows. Some was a deliberate policy of reserve diversification away from dollar assets. And some was a strategic geopolitical move. Russia, for its part, liquidated essentially all of its treasury holdings after 2022. Smaller holders have been quietly trimming around the edges, like rats leaving a sinking ship, but without the public fanfare. Meanwhile, central banks worldwide have been on an unprecedented gold buying spree. In 2024, they collectively added over 1,000 metric tons of gold for the third consecutive year, bringing total central bank holdings to approximately 36,000 metric tons. The BRICS nations alone now hold more than 6,000 tons, roughly 20% of global central bank gold reserves. Between 2008 and 2021, BRICS' share of global gold reserves surged from 5% to 22%. Gold isn't just a hedge against inflation anymore, it's a hedge against dollar dominance itself. It's a silent vote of no confidence in the existing monetary order. And these countries aren't just buying gold as a passive store of value. They're actively building alternative financial infrastructure. The BRICS pay system is expanding as a cross-border payment alternative to SWIFT. Russia, India, and China are conducting over 90% of their bilateral trade using local currencies, with the yuan, rupee, and ruble completely bypassing the dollar. China's CEPS payment system processed significant volumes in 2025, and while it still can't match SWIFT's reach, it doesn't have to. It just needs to handle enough trade that countries have a viable alternative when the political situation demands it. This isn't about replacing the dollar overnight, it's about creating options, about building a parallel financial universe. BRICS nations are also piloting a gold-backed settlement unit, essentially a blockchain-based trade currency pegged to their collective gold reserves. The pilot launched in late 2025 with 100 units backed 40% by gold and 60% by BRICS currencies. Whether this actually scales into a genuine reserve currency alternative is anyone's guess, but the fact that they're testing it at all shows how seriously these nations are taking de-dollarization. They are preparing for a future where the dollar is no longer the only game in town. If you're still with us, you're clearly someone who wants to understand the deeper currents of global finance. Consider subscribing to Finance Deciphered for more insights that the mainstream media won't tell you. Now, none of this means the dollar is about to lose its status as the world's reserve currency next week, or even next year. In the 1990s, the dollar made up over 70% of global currency reserves. Today, it's 59%, which is still dominant by any measure. The British pound lost its reserve status gradually after World War II, but it didn't disappear. It just became less central. That's probably the more realistic trajectory here. Not a sudden collapse, but a slow, grinding erosion, as other currencies and assets take up more space in central bank portfolios. It's a death by 1,000 cuts, not a single fatal blow. But the cumulative effect will be just as profound. The question is, are you prepared for a world where the dollar is just another currency, not the only currency? So maybe you're thinking, okay, this is concerning, but if it was really that bad, surely markets would be freaking out more than they are, right? Well, you probably should have seen it coming at this point, but let's take a look at a good number and explain why it's actually a bad number. Japan increased its treasury holdings by $8.9 billion in September 2025, bringing them to $1.19 trillion, the highest level since August 2022. At first glance, that sounds reassuring. Japan isn't selling, they're buying more. Crisis averted. But there are some other caveats. Lee Farage, a strategist at State Street, pointed out that this continued buying of treasuries might actually be a factor behind the yen's ongoing weakness and could signal that Japanese investors are wary of Japanese government bonds even as domestic yields rise. In other words, Japanese institutions are still pouring money into US Treasuries not because they're confident in US fiscal health, but because they're even less confident in their own domestic alternatives. That's not exactly a vote of confidence in anybody. And here's the kicker. If Japanese institutions eventually do regain confidence in JGBs as yields rise further, or if they're forced to buy Japanese bonds to meet regulatory requirements or pension obligations, then all that treasury buying could reverse very quickly. The fact that they're still buying now doesn't mean they'll be buying 6 months from now when the math changes. It's a bit like watching someone standing at the edge of a cliff saying, "See, I'm not falling." That's great, but the question isn't whether you're falling right now, it's whether you're going to take a step back or a step forward. Now, it certainly doesn't help that Japan's debt to GDP ratio already exceeds 230%, far above peers like the US at 125%, the UK at 115%, or France at 101%. Japan has been able to sustain this level of debt because interest rates were effectively zero for decades, meaning servicing the debt was cheap. But as rates rise, even to relatively modest levels like 0.75%, the cost of servicing that debt climbs. And if bond yields keep rising as markets demand higher returns, Japan's fiscal position becomes increasingly precarious. Prime Minister Takaichi's proposed tax cuts and stimulus spending might be politically popular, but they spooked bond markets precisely because they raised questions about long-term debt sustainability. When bond yields surge in response to fiscal policy announcements, that's markets saying, "We're not sure you can afford this." And when those yields rise high enough, they pull capital away from foreign assets and back toward domestic bonds, whether policymakers want that to happen or not. This brings us to the biggest caveat of all. Even if Japan doesn't deliberately dump treasuries, even if the GPIF decides to hold steady, and even if yen appreciation happens gradually rather than all at once, there's still one scenario that could force everyone's hand: a loss of confidence in the U.S. fiscal trajectory itself. The Congressional Budget Office projects that U.S. debt will hit $50 trillion by 2034 under current policies. That's not a crisis scenario. That's the baseline forecast. Interest payments are projected to exceed $1.7 trillion annually within the next few years, potentially becoming the largest single-line item in the federal budget, surpassing even Social Security or defense spending. If markets start pricing in a higher risk premium for holding U.S. debt, whether because of political dysfunction, repeated debt ceiling crises, or simple arithmetic about debt sustainability, yields could spike not because of foreign selling, but because of domestic skepticism. And here's the brutal feedback loop. If Treasury yields rise significantly, it makes U.S. assets less attractive relative to alternatives. That accelerates de-dollarization, not because countries are making a political statement, but because they're making a financial calculation. Higher U.S. yields also strengthen the dollar in the short term, which makes American exports less competitive and imports cheaper, worsening the trade deficit. A worse trade deficit means more borrowing, which means more Treasury issuance, which requires even higher yields to attract buyers. Japan's potential selling isn't the cause of this cycle, it's a symptom, but it could be the trigger that turns a gradual trend into a sharp correction. Ernie Tedeschi, director of economics at the Budget Lab at Yale and former chief economist in the Biden administration, put it bluntly. It would send shockwaves around world financial markets if one of the most reliable buyers of treasuries is no longer reliably in the market for it. Even Finance Minister Cato's card on the table comment was immediately followed by, "But I think whether we choose to use it or not would be a separate decision." Because, as Win Thin, global head of market strategy at Brown Brothers Harriman noted, threatening to dump an asset of which it is a major holder means that Japan can hurt itself in the process. If Japan sold massive amounts of U.S. debt, it would spike Treasury yields, which would crater the value of the treasuries they're still holding, effectively destroying their own wealth. It would also cause the yen to appreciate sharply, making Japanese exports more expensive and potentially sending their economy into recession. It's the nuclear option, and like all nuclear options, its power lies in the threat rather than the execution. But that doesn't mean it won't happen. It just means it won't happen as a deliberate policy choice. It will happen as a series of smaller, rational decisions made by pension fund managers, insurance companies, and central bank officials who are simply trying to optimize their portfolios in a changing interest rate environment. $10 billion sold here, $20 billion there, none of it dramatic, all of it adding up. So why hasn't Japan sold yet? Because so far, the math still favors holding. The yen's weakness, as frustrating as it is for Japanese consumers, still benefits exporters. U.S. Treasuries, despite all the concerns about American fiscal policy, remain the most liquid and widely accepted safe asset in the world. And Japan's economy, for all its challenges, isn't in an acute crisis that would force immediate repatriation. But that calculus is shifting. Every Bank of Japan rate hike narrows the yield differential. Every uptick in Japanese inflation increases political pressure to defend the yen. Every additional $1 trillion added to U.S. debt makes foreign holders just a little bit more nervous. And every new piece of financial infrastructure that BRICS nations build makes de-dollarization just a little bit more feasible. The reality is that it's just too early to tell whether we're heading toward a genuine crisis or just a gradual rebalancing. The American economy is not invincible, but it is both very large and very privileged. The size of U.S. consumer and financial markets means that things don't move as quickly as they might in smaller economies that are easier for foreign institutions to exit. We also have some of the most entrenched agreements, alliances, and partnerships with almost every major economy worth mentioning. These have all been tested clearly, especially over the last few years. But no matter how hard the system is stressed, it won't fall apart overnight. In the short term, that's good because it means we have time to see problems developing and potentially adjust course. But it also means that if other countries, investors, and institutions start working around the dollar system rather than within it, the process of untangling those relationships will take far longer and be far more painful than a sudden crisis that forces immediate reforms. The dollar's dominance didn't happen overnight, and it won't disappear overnight either. But when the British pound lost its reserve status after World War II, there wasn't a dramatic crash or a single moment when everything changed. There was just a slow, steady erosion. As other currencies became more important and the pound became less central, that process took decades, and by the time it was obvious that the transition had happened, it was far too late to reverse it. Japan's $1.2 trillion in treasuries isn't a bomb waiting to explode. It's more like a crack in a dam that's been slowly widening. The water hasn't breached yet, but the pressure keeps building, and eventually something has to give. Whether that happens through deliberate policy, market forces, or simple portfolio rebalancing doesn't really matter. The effect will be the same. Now, it certainly doesn't help that a lot of the decisions shaping this trajectory are being made by people in both Washington and Tokyo who won't be around to see the full consequences of their choices. Short-term political incentives often conflict with long-term economic stability, and that's true on both sides of the Pacific. But here's the most crucial question for you, the viewer. Are you prepared for a world where the dollar is no longer the undisputed king? A world where your savings, your investments, and your future are exposed to risks you never imagined? We've shown you the cracks in the dam, the slow erosion of trust, and the quiet moves being made by global powers. The next step is to understand how to protect yourself and even profit from this monumental shift. Watch our next video, where we'll reveal the secret alliance against the petrodollar. Who's really pulling the strings? Don't miss it. Subscribe to Finance Deciphered and hit the notification bell so you don't get left behind in the greatest financial realignment of our lifetime.